Howdy, Jacob here. Today we're looking at company 62 in our generic stock screener, Adtalem Global Education in the diversified consumer services industry. 2.4 billion market cap on 2.9 billion enterprise value. Growth is actually down from 10 years ago, but I presume there was a sell-off in 2016, and I'm not seeing that. So I really question how revenue dropped so much or why that is the case. But in the last 7 years or so, it actually is about 3% to 5% CAGR annually. No dividend. They cut that dividend when revenue got hit pretty hard, and they started focusing on margins, it looks like, because gross margin had quite a bit of improvement as well as operating margin. And return on invested capital is still averaging mid-single digits, so nothing too impressive there. Balance sheet shows 274 million cash on hand with 695 million long-term debt. That 695 million long-term debt in relation to their 5-year average free cash flow is about 5 or 6 years, because we are looking at about 100 million in average. And they made a huge net acquisition here of almost $1.5 billion, which I'm not sure how they funded that, because they only had 400 million in cash, and then it says they bought back some shares, bought back debt. So, over here, 797. Okay, so for some reason it's just a year off here, but funded it through debt and then been paying that down the last couple of years. Otherwise, use of cash outside of that huge net acquisition is share repurchases. So I think we're ready to start making some assumptions. I would say on the revenue growth side, probably feel good about a 4%, 13 PE. I don't see a reason to put any. It looks a little bit not even as good as the market type thing. Okay, let's do a little bit of a range here, 8, 10. And we're buying back quite a bit of shares, but 2.4 is 24 million. 24 million they've been buying back. I mean, 4 times that is 123 million. That's pretty much as their 5-year average got. But I feel pretty comfortable with that. So let's do 4%. That's about 80% of their last 3-year average free cash flow, and about 90% of their 5-year average free cash flow. But that acquisition did improve their free cash flow and earnings, so they do produce quite a bit more. And I feel pretty comfortable with that assumption. So they are buying back quite a bit of shares. That is essentially putting money in your pocket, because all else equal, the price should go up of the stock due to the market cap not changing and then there being less shares outstanding. But for me right now, this price doesn't necessarily say it's a screaming deal. And so, one, the share repurchases likely aren't the best idea. And then, two, it's not making up for the fact of, the growth just isn't necessarily there in my projection. But I do hope you enjoy the video and have a great day.